Hello everyone, good morning and welcome to today's lecture. So in last lecture, we discussed about the various requirements, for the auditor, what they are required to report in their audit report along with a, statement to the bank. And we discussed that these requirements are based on three categories, that the NBFC, whether, applicable to all, NBFC accepting deposits and NBFC not accepting deposits. Okay. So we discussed in detail those requirements. Okay. And we discussed like, okay, which are the things along with the requirements, like we are required to check. For example, we were required to check for the deposits. So we went and we checked for the acceptance of public deposit Reserve Bank directions. Then we went and we checked the different provisions of these directions with respect to minimum investment grade credit rating for any of these scheme. Then we also went and we verified that, okay, in case of deposits, whether they have been accepting deposits within exceeding the limit, regularization, and then we discussed that, okay, in case of whether the NBFC is complying to the prudential norms, asset classification, provisional requirements. So all those things we went and we verified that whether they are doing it or not. Okay. Then we checked for other requirements for the quarterly returns. Remember NBS3, NBS2. So we went and we checked for each and every requirement over there. Am I audible now? Okay. So yeah. So these were the things we verified and we checked. Now I'll be coming to one important area, that is the additional disclosure. See, there were two things. One, a statement which is required to be given by the auditor. Second, the statement that is required to be given by the management as a part of financial statement. Okay, so there are some additional requirements by the management. Okay, and they are required to provide those details in their financial statement along with the respective details of the financial statement of the company. Okay, before I proceed further, just one quick question to all of you guys. When I'll prepare the financial statement of NBFC, which framework will be applicable to me? So based on which framework I need to prepare the financial statement? Okay, Manini. So which framework they have to comply with while preparing the financial statement? Pretty easy question, guys. Trust me. I'll show you a financial statement also of the NBFC, and we'll discuss that provision too with respect to the financial statement. But the point is that we should be aware what is the basic framework that we need to follow. Correct, Boni? Correct, Sandhya? So the basic framework that is there for NBFC to prepare the financial statement is none other than the Schedule 3. Don't forget that NBFC is a company. NBFC is a company registered under Companies Act, formed under Companies Act. So if it is a company, means the provisions of Companies Act are still applicable to them. Okay. And if NBFC is also listed, then the SEBI regulations, ICDR regulations will also be applicable to them. It's not like that we need to follow the master direction, but we need to follow the rest of the regulatory requirements also. So in case if it is a company, Schedule 3 it's there, and in case if it is a listed company, then you need to comply with the SEBI ICDR also. I hope I'm clear. So division 3, yes, division 3 of Schedule 3 is specifically there for this particular thing, this MGFC. NBFC's financial statement. There's some technical glitch at my end. Okay. Meanwhile, see, what is the scenario is NBFC is required to prepare its financial statement as per Schedule 3. They prepare it, they comply with the rest of the requirements also. But over and above that, there is an additional requirement which is prescribed by Reserve Bank of India under their master directions, that NBFC is required to present a statement that they have given, and we will discuss now, a statement along with their financial statement, okay, which provides them the additional detail. And these additional details are then, again audited by the their statutory auditor. Okay, so this is generally known as a schedule to balance sheet under master directions. Okay, now what this schedule to balance sheet then generally covers, it covers on the same side, same things only, liabilities, breakup of liability, then asset and breakup of assets. Okay, so some additional disclosure with respect to the liabilities and assets. I'll be discussing this. Okay. Just give me a second. So a separate schedule to balance sheet is required to be given by NBFC, and that is to be a format prescribed under, remember we were talking about NBFC SI ND regulations, that is NBFC systematically important non-deposit accepting master directions and NBFC non-deposit accepting directions. Okay, under these regulations, this particular statement annexure is already given. Let me show you. So this particular statement is already prescribed under this these regulations, and this is, as I said, different for both of the categories. Different for both of the NBFCs and both of the categories. So it is different for, you can say, for my normal NBFC, systematically important NBFC, and a bit of different for my non-systematical and non-deposit accepting. So this is the one that is required to be given. If you see over here, it requires us to report, management to report breakup of loans and advances. So loans and advances availed by the NBFC company inclusive of interest accrued. So which are the loans and advances they are availed, details of that. Then breakup of 1F above, that is public deposits over here. Outstanding public deposit inclusive of interest accrued thereon but not paid. This is the this is the critical one, but not paid. Interest accrued but not paid. So in form of debentures, public deposit, whether in form of debentures, but public deposit in form of partly secured debentures, other way of public deposits. Okay. Then on asset side, we are required to give breakup of loans and advances, including bills receivable. Again, bifurcated in secured, unsecured. Then breakup of lease asset and stock on hire and other asset, counting towards asset financing activities. So lease, my stock on hire, other loans which are based on the asset financing activities. So all these things. Then I need to give the breakup of investment, like current investment, shares, equity shares, preference, bonds, unit of mutual fund, government. Again, same way, unquoted, long-term investment, unquoted, then long-term. And after that, we are required to give details of investment with respect to the investment in subsidiaries or group wise. So if you have if any of the entity in the group has borrowed, okay, so the details of that. Borrower group wise classification, subsidiaries, companies in group company, other related parties. So what is the secured amount, unsecured amount? Then investor group wise classification for all investments. So where we have done the investments like in subsidiaries, companies in same group, other related parties, their fair market value and their book value. Then we are required to provide this other information with respect to the gross non-performing asset. How much of it is related to the related parties, how much it is related to the non-related party, net non-performing asset after provisions, and again the bifurcation for that. Okay, and asset acquired in satisfaction of the debt. So these are the things that we are required to report, or management is required to report in this statement. I'll show you the example. Okay. So okay. Okay, so these are this is a particular schedule that I was talking about, in NBFC's financial statement. Okay, if you see over here, it says that these are the disclosures required by NBFC under master direction. Okay, these are the disclosures which are made under the master direction, required by the master direction. Okay, and there are multiple disclosures which are done under the master direction, and these are all disclosures of the same. Okay, so one is with respect to the investment. Then there are many requirements based on the various type of NBFC. So as I told you, it may differ on the based on the type of NBFC, and this is another type of NBFC, so they might have a additional disclosure requirement. Okay, so you will see a lot of other reporting also, like derivatives. Then we saw some important ratios like here CRAR ratios, tier 1 capital, tier 2 capital. Remember, this is required to be 10% and total 15%. So these ratios are required to be maintained. So these ratios are there. Then exposures. After that, it's registration obtained from other financial sector regulators. Details of credit rating agency. Remember, I told you that okay, for each and every type of deposit scheme, there should be a credit rating agencies. So these are the credit rating agencies, and they have obtained for this particular thing. So for non-convertible debentures, this is a credit rating that they have obtained. Whether this has been change or mitigation in rating during the year, it says no. So like this way, they have mentioned all the credit ratings for all these schemes. It may happen that they have taken the credit rating from multiple credit rating agencies, like for example CRISIL, ICRA, CARE. Okay, over there India Ratings. So they might have obtained credit rating for, let's say for example, same non-convertible debenture from multiple rating agencies. That's fine. Exposures to NPA, we saw just now. Sector-wise NPA, movement of NPAs, we saw a disclosure on the NPA. Okay. If the company was onto the gold, then remember there was a requirement of the gold also, that 50%, there should be 12%. So that is there. So this way they are required to disclose all these additional informations in their statement based on the different master directions or type of NBFC in their balance sheet, along with the rest of the disclosures that they are required to make as per the Schedule 3. Clear? Sorry. Yeah. Okay. So that is just to give a glimpse to you guys that okay, how the disclosures are made with respect to the SEBI disclosure requirements. Okay. Oh, sorry, not RBI disclosure requirements. Along with that, I just want to show you quickly how the Schedule 3 is adopted, Division 3 is adopted for a particular company in case of an NBFC. Okay. Now, in case of an NBFC, what happens is it's bit different than the Schedule 3. Division 3 is different than the Division 1 and 2. So in Division 1 and 2, I'll just show you. During company audit, we discuss about the Division 1 and 2 of Schedule 3. So over there, we discussed, okay, how the balance sheet works. Like in case of a balance sheet, we have an equity and shareholders funds first. Then we have a non-current liability, current liability, and the asset side, non-current assets, and then current assets. So we discussed this particular area that, okay, this is how one, like first non-current and then current. Okay, but in case of division 3, it's a bit different compared to the division 1 and division 2. The reason, because in case of division 3, it's an NBFC. So in case of NBFC, what is done is, first the liquid things, the most liquid things are presented, and then the non-liquid items are presented in the balance sheet of NBFC. So let me show you that one also. Okay. If you see the balance sheet of NBFC, you will find, as per division 3 requirement, first we will disclose cash at bank, bank balances, derivatives, trade receivable, and the way we move down is on the basis of the liquidity requirements. Okay. So the most liquid items are disclosed first, and then the least liquid items are disclosed subsequently. That's the difference, first difference with compared to the NBFC division 3 and the normal division 1 and 2 applicable to the various companies. Okay. Then, so they are required to disclose this particular area, like trade receivable, loans, investment, other financial assets. That's there. Again, on the same line, then comes the non financial assets, that is more onto the side of non-current assets. Okay, so here my terminology totally changed compared to the financial statement that we saw. In the financial statements earlier that we saw, let me open the financial statements over here, schedule 3. So earlier the financial statement we saw in division 1 and division 2, the terminology was used current and non-current assets. So if you go, you will see non-current assets, current assets. Okay, so this is the terminology used, and within current assets we have a financial assets. Same over here also, within non-current asset we have a financial asset. However, in case of an NBFC, the prime focus is on the financial asset because of the nature of the business they are doing, and hence if you see, you will have a bifurcation in case of asset, financial asset and non-financial asset as a primary bifurcation. Okay, so this is the primary bifurcation for them, that financial asset and non-financial asset, and then on the basis of liquidity they again bifurcate in respective heads. Same way in case of liabilities. So in case of liabilities, first financial liability. Okay, the liabilities which are payable in a near future compared to the liabilities which we pay, which are payable after some point in time. For example, payables, trade payables, these will be paid within a year compared to the debt securities and borrowings that may have a time of 4 years, 5 years, or depending upon the tenure of the borrowing. Okay, same way non-financial liabilities like current tax liabilities, provisions, and other. And then the last comes the equity, because that's something, it's a part and it's going to be there for there with the company. So this is how the balance sheet of the division 3 in case of NBFC is prepared. So there is one question. So are we required to go through each and every disclosure requirement of the NBFC of every type of NBFC? Answer is no. So your study material already covers, the disclosures and the details that are going to be there, like, for the NBFC, but primarily I'll suggest the NBFC requirement that we discussed in the last lecture also, like these two master directions, systematically important non-deposit accepting and systematically non-systematically important, plus master direction on public non-banking financial companies accepting public deposits. These are the important ones which are which requires your understanding and which requires detail of your study, because these the directions cover up most of the chapter, where we discuss prudential norms, where we discuss asset provisioning, where we discuss credit rating requirement, additional disclosure in the balance sheet. So all these things are there in these three your regulations. Clear? Any doubt? Any doubt? Okay. Now, that was the balance sheet part of the Schedule 3. Let's go to the profit and loss account. So this is the standalone statement of profit and loss account. Okay. Now here, compared to the Schedule 1 and Division 1 and Division 2 of Schedule 3, if you see, my revenue from operations will be made up of interest, fees, net gain and net gain on fair value changes, and then comes my sale of service. But my prime income is interest from interest income, because it's an MBSE. So the interest incomes and those financial finance charges and everything will be the first priority in your revenue compared to the sale of service. Same way, your expense, the first part will be finance cost, fees, commissions, and then your employee benefit, depreciation, and other expenses. Rest on the majority line, it's same like a Division 1 and Division 2. Okay, if you have seen the Division 2, it will be same on the majority line. There will be few differences with respect to the, let's say for example, as per the RBI guidelines, we are required to create some additional reserves. So those additional reserves, accounting policies, difference in accounting policies, that might be applicable here, and on the basis of that you might see a sum of changes with respect to the schedules. But on the majority side, it's the same. It's same like Division 2. There is no change with respect to that. The only part that will change is that the type of items that will be there in your schedule compared to a normal manufacturing company, it will be different, because this is not a manufacturing, it's a sort of a bank or non-banking financial corporation. So loans, advances, interest, that will be more. Okay. For example, see this one. ECL application. So this is the application for ECL. The whole calculation on the ECL, it's done on loans. Okay, expected credit loss. Then investment, details of investments are there. So the rest of it same. So I'll not invest much time on the rest of the schedules because they are same. The only difference was that in balance sheet and P&L that I wanted to disclose. Clear? Any doubt? Okay. If no doubts, let's take one MCQ, and then we can move forward and we can discuss further. Okay. This will enhance our understanding with respect to the NBFC and their concept of principal business. Sudarshan Limited is the company registered under Companies Act 2013. The company is engaged in business of loans and advances, acquisition of shares, stock, bonds, debentures, securities issued by government and local authorities. For the year ended 31st March 2022, the following are the extract of the financial statement. That includes my paid up share capital, Non-current loans and advances, current loans and advances, total asset of the company, intangibles, profit for the year, income from interest and dividends, and gross income. Now, directions intend to apply for the registration of NBFC, okay, under Section 45 IA of the Reserve Bank of India. You need to advise whether they can go and apply for the NBFC registration or not. So this is the detail given to you. Now you tell me whether they can apply or they cannot apply. Based on the details that we saw under Section 45 IA, we saw registration details, we saw prudential norms requirement for with respect to the registration, or master directions on NDSI regulations and ND regulations. So you tell me whether in the current case they can go for a registration or not. So I'll give you two hints. Hint number one, application of 45 IA. Hint number two, application of NBFC, SI, ND regulations. These two things you need to apply. I'll give you 2 minutes. Do your calculations and tell me. Very important. Reason because this will enhance your clarity whether, like whatever we have discussed in last lecture, that how you need to apply that in a practical way. The key point is not applying the full, regulations, the regulations which is relevant to the registration. Okay. Remember the relevant registration regulation. There was some point with respect to the registration in the regulation that we need to check whether it's being applicable over here or not. Okay, and if you say it is required, it is not required, just let us know with the reasons why. But they want to apply, and whether they can get the registration or not, it's something we need to understand. Okay, so I already got one answer. Correct. Okay, good. Good Manini, good Boni, good Sandhya. Correct, Karthik. Okay, Let me discuss that. So I'll remove this as of now. With respect to the registration, when we are going for the registration, what we need to see is, let's go to the requirement first. So section 45 IF says that the NBFC, that should be a financial institution company receiving and their principal business that I will highlight should be of receiving of deposits and lending. Okay. Now that's the very critical point to see over here is, my principal business should be of receiving and of deposit and lending. Okay. Now how will I identify my principal business is that of lending and depositing? So two things. One, there is nowhere define how to calculate principal business, but there is a test given, okay, like a basic understanding in the company act also, or on respect to this particular test, that's a 50-50 test, that if your lending business or your financing business constitutes more than 50%, more than 50% of your total asset or total revenue, then it will become your principal business. Okay, so first of all, I need to establish the requirement of the principal business. Okay, now here my total assets are 618.55 CR. Okay, and if I want to establish the requirement, okay, of like whether it's a its principal business is to obtain loans and advances or to give in loans and advances, I need to see what is the total loans or activities from the loans and advances, let's say financial assets. So that is 75.5, this one plus 294.33, this one it will come to 369.83. Now what is the percentage? This is the, I need to calculate this by this, the total loans compared to the total assets, divide by 1. So I need to divide it by 618.55. It comes to 59.78%. So my total financing assets is more than 50% of total asset. Okay. And my total finance revenue or revenue from such NBFC activities, that is lending and accepting deposit. Okay. So finance related revenue should be more than 50% of total revenue. That is over here my total revenue, yeah, gross income, triple 123. Okay, and interest income from interest and dividend, that is related to financing. So interest and dividend 62.31. It comes to 56%. Again, that is more than 50%. So my first condition is satisfied. I can say the principal business is now of the company, the principal business of the company is of what you say, preparing and of NBFC, accepting and lending of deposits. So that is of NBFC is there. Okay, the principal business is there. Now the question comes is, okay, second thing, whether the net on funds criteria is being complied or not. Whether the net on funds criteria is being complied or not. So here, if you see, what is the net on funds criteria? The net on funds criteria goes for the, usually it was as per the act it was 25, but as per the regulations, net on funds criteria was 200 lakhs, that is 2 cr. So my net on funds should be more than 2 cr. In the current case, see, in the current case, if you see your total assets and the total current assets and current non-current assets, everything is more than, way more than 2 cr. So it's not in case of, that, okay, my net own funds will not be that, will less than 2 cr. But to calculate the net own funds, we are not given any additional information over here. Okay. So we need to assume, yes, net own funds exceed 2 cr. And accordingly, yes, this entity can get registered itself for the what do you say, NBFC. Now, total asset exceeding 500. So some of you are talking about one of the criteria. Okay, let me explain that again. Just let me explain that one also. So some of you are talking about one of the criteria for the balance for this particular NBFC is NBFC SIND, where we discussed that the asset side or total asset should be greater than 500 crore. Yes, that is there, but that's for the classification, not for the registration. See, there are two things. One is the registration, second is the classification. Okay. So in this case, yes, this is the NBFC SIND. Systematically important non-deposit accepting based on the total asset. But if you go in the question, okay, if you go in the question, it's there. They have a total asset more than 500 crores, and that is classification, but that has nothing to do with my registration. Clear? So for the registration, I need to see 200 lakhs requirement that was there. Remember, I discussed in the regulations that, okay, this is the certificate of registration details, 200 crores general, 2 crores general. So 2 crores general requirement that we discussed. NOF exceeding 25 lakhs or such other amount. Such other amount was 2 crores. Not the classification. Okay. 500 crores is for the classification, but for the certificate of registration, it's 2 CR. There's a difference between both. So again, in the same case, comparing 500 CR, yes, we can get the type of the entity and we can identify which regulations will be applicable, but it's not for the registration. I hope I'm clear. Okay. So now this principal business test, that is 50-50 test, is that we applied now. That my total asset and the financial asset, my financial asset should be more than the 50% of the total asset. Then only I can say my principal business is of receiving deposit and lending of money. So that's the test we applied over here. Clear? Any doubt? Yes, the 25 lakhs criteria has been revised to the 2 CR. 25 lakhs was given in the act. but it is also said that there's such other amount which is prescribed, which is now 2 CR, that we need to refer to the 2 CR. Any doubt? Okay. If no doubt, let me take you through one MCQ. Okay, one question more I'll discuss. So let's say, for example, there's a XYZ NBFC, XYZ Limited NBFC. Okay. Now this NBFC is registered with RBI. Below is the position of net own funds of the of NBFC on various dates. Okay, this is the date. This is the NOF. Let's say we'll go quarterly, 30 June, 30th September, 31st December, and 31st March. So net own funds requirement. So what was the net own funds for the NBFC on these particular dates based on the calculation as per the these directions? Okay. So it was 2.5 CR, 1.5 CR, 2.4 CR, and 3.4 CR. Okay. Now, Mr. Z, statutory auditor of XYZ Limited, wants to report, okay, wants to report that the NBFC was non-compliant to the certificate of registration requirement. The company was not eligible to hold the certificate of registration, was non-compliant to the RBI, I'll say RBI guidelines, and was not eligible to hold certificate of registration on 30th September. Okay, so company was not eligible to hold certificate of registration on 30th September, and they were non-compliant to the RBI directions. Okay, this information was was included in the statement prepared by auditor. Okay, prepared by auditor under RBI audit report directions. Okay, so this particular statement that they were non-compliant and they were not eligible to hold certificate was included, and was in the statement that was prepared by the auditor under RBI auditors report directions, and it was then submitted to the RBI. Now you tell me whether this particular reporting is correct or there is some changes that are required to be made in this reporting. Now I'm talking about a criteria. Remember, auditor is required to report certain things for the three type of NBFCs. NBFCs applicable to all, NBFCs accepting deposit, NBFC not accepting deposit. So one of the criteria was whether the NBFC is eligible to continue to hold the certificate of registration. One of the criteria was that. Now from that point of view, you tell me whether the auditor's reporting over here is correct, because let's say, for example, the next thing is management has challenged, okay, the reporting done by statutory auditor to RBI. So management was saying that you have performed the incorrect reporting. This was not required to be reported. You tell me whether this was required to be reported or not. Whether this was required to be reported or not. Correct, Boni. 16, no, it's not with respect to the credit rating. It's with respect to the NOF, net on funds. Manni, I'll suggest your answer is correct, but the reference point is wrong. Your answer is correct, but the reference point is wrong. See, I'll tell you. In the current case, okay, what was the requirement for the reporting? First of all, we need to understand that. What we need to report is whether it's applicable for all NBFCs, whether NBFC is entitled to continue to hold such certificate of registration on every 31st of March. Every 31st of March. Okay. In our case, here on 31st of March, the NOF is 3.4 CR, which is more than the required of 2 CR. So yes, on 31st March, they continue to hold. On 31st March, they continue to hold. although there was a, on 30th September, the NOF got reduced and then it was regularized. So there are provisions, different provisions wherein it says that if it falls below the 200 lakh rupees, okay, then auditor is required to give a certificate that it was complied by the end and it was fine. Okay, but it never says that you do not hold, you do not, like not eligible to hold certificate of registration. So on 31st March, we are required to check whether there was, 2 CR limit appropriate on fine or not. And in the current case, it was fine. Hence, this particular reporting that is not eligible to hold certificate of registration is incorrect. Okay, so so the auditor is like, the statement is incorrect that the entity is not eligible to hold certificate of registration on 30th September because we are required to check on 31st of March, not on any other date. Yes, there is a requirement, that is if the NOF falls below. So I'll show you the requirement also. So it's a requirement. It's from the provisions. It says that if the NOF, which currently falls below than 200 lakhs, then statutory auditors submit a certificate compliance with the prescribed level by the end of the period. Okay, so a statutory auditor need to give a certificate that okay, it has been complied by the end of period, but nowhere it is written that okay, it's you are not eligible to hold. And this particular compliance certificate is again given in conjunction with the statement that we are preparing. Over there, we are also mentioning that this limit has been obtained, attained of 200 lakhs or 2 CR. Here in the correct case, it's 3.4 CR. Clear? No. So there is one question. What if this was not 3.4 CR, but it is 1 CR? If it is 1 CR, then tell me what will be the scenario. Let's say this is 1 CR, not 3.4. This is 1 CR. So on 31st March, it was 1 CR, but let's say on 30th September, instead of 1.5, it was 3.5. Now you tell me, what will be the scenario here? What will be the answer here? If I change this particular scenario, like NOF on 31st March, 1 CR, but 30th September or 31st December, 30th June, it is more than 2 CR. Come on, pretty easy. Correct. If this is the case, then in this case, we need to report in our statement, yes, the entity was not eligible to hold certificate of registration on 31st March, okay, because it was not meeting the requirement of 2 CR. So that will be reported. Okay, and that is required to be submitted to within the due date. That's there. What was the due date? Okay, what is the due date of the certificate? We are talking about. What is the due date of this particular certificate? By what time we need to submit it? Due date. Remember we discussed in last lecture? Correct, Manini? Correct, Rakesh, Kalesh, Shailendra. Correct, Shishti. So the due date is 1 month from the date of finalization, or 1 month from balance sheet date, or 30th December, whichever is earlier. I need to submit this statement or certificate. Okay. Now, in form, which form? Which was the form? Which was the form? Correct, Boni. Correct, Rakesh. Form was SAC. Remember, we discussed this particular form SAC. Let me show you. So that we discussed format of statutory auditor certificate form SAC. But the problem was I was not able to disclose. I was not able to show the form because the portal was not working, and I was the portal was down yesterday, and I was not able to take out a particular copy of that particular of form. But that is the form that we are referring to over here. Format of statutory auditor certificate, that is SAC. Okay. Okay. Let us see one more question. This will be helpful for us to understand the requirements that we discussed just now. Just give me a minute. Okay. Now let us see one question. During the year 2021, ABC Limited was an NBFC involved in accepting public deposits. During the period, for one of its schemes, the credit rating was downgraded below the investment grade However, by the end of the year, it was reinstated at the same level as it was earlier. You as an auditor are required to comment whether such matter is required to be reported as per the master directions. So you need to tell me where you will report and whether you will report this thing or not. Whether such matter is required to be reported as per the master directions, that is very important. Whether it is required to be reported, that's a very important thing. Okay. So come on, guys, pretty easy. Whether this is required to be reported or not. See, to decide or to understand whether it is required to be reported or not, we need to refer to the audit reporting requirements in the current case. Okay. And the audit reporting requirements, like remember we discussed, there is a statement that the auditor is required to submit. We need to see the requirement of that particular statement, and in that statement, one of the requirement was that the auditor is required to report whether the credit rating that was given is same, or it's same, and whether there has been change or not. If there has been any change, then whether that, like, it has been reinstated or has been in the force or not. So that was one of the requirement. Let me show you. So over here, it says that, remember we discussed about this point, whether the same is, the credit rating is in force or not. Also, we discussed with respect to the credit rating is whether the minimum credit rating, whether the NBFC is accepting public deposit without minimum investment credit rating, and second was whether the credit rating is in force or not. So that is a particular point that I am referring to. I'll also show you the provision over, of particular what is it, the detailed provision. Give me a minute. Yeah. Okay, so these are the audit requirements, audit directions that we are referring over here. Okay, and this is the one in case of the non-banking financial company accepting public deposits and the matters that the auditor is required to include in the statement. Okay, one of such requirement is whether the non-banking financial company is accepting public deposit without minimum investment grade credit rating and from an approved credit rating agency. This one. Second, in respect of a non-banking financial company, which is referred in clause 3, this one, whether the credit rating for each year of the fixed deposit scheme that has been assigned by one of the credit rating agencies listed in non-banking financial company, this direction is in force. So first of all, whether that is in force means if there is any change, then we are required to report that, okay, that was not in force, but that has been changed. Number 2, whether the aggregate amount of the deposit outstanding at any point during the year has exceeded the limit specified. These are the 2 points that we are required to report as per the master direction from the reporting point of view, state auditors reporting point of view. Plus there is another requirement which is there. I'll show you, which is acceptance of public deposit directions requirement. In there, there is a specific requirement. If there is a change in the credit rating, okay, then the auditor is required to intimate that change in the audit credit rating also to the bank, or bank means here RBI. Let me show you that also. Yeah. See, this is that particular regulations that I'm talking about, downgrading of credit rating. So in the event of downgrading of credit rating, what is required to be done is that in case of a downgrading, either the company should stop accepting fresh deposit. All deposit either will run to the maturity, okay, and within 15 days they need to report to the Reserve Bank that the credit rating has been downgraded. Okay, so this is, they need to report like this way for the downgrading of credit rating, if that has been downgraded. If that has been regularized, then this particular requirement, all exiting deposits shall run to maturity, and this will go away, but still you are required to report within 15 days of the downgrading to the Reserve Bank. So that is another reporting requirement which is there for the downgrading of what you say, credit rating. Clear? So in our question, which was that whether the downgrading of investment grade, below investment grade, is required to be reported? Answer is yes. And what we are required to report, whether the 2 points which we discussed. Clear? Correct, Rakesh. Correct, Sandhya. Yes, absolutely correct. Correct, Boni. Shrishti, it is required to be reported if there is a downgrade, although they have subsequently, received it on the same level. But the point is, when it was downgraded within 15 days, the NBFC is required to report, and the auditor is also required to report whether there was change or not. So here the period is not said that as on 31st March you need to say, provide whether it was in force or not. It's not mentioned anywhere that it should be reported on the 31st March itself. But it says that at any point in time it was in the force or not. Okay, so we are required to report. Okay. Another short question, but good one. ABC Limited was involved in providing loans on gold jewelry. During the financial year 2021, the NBFC maintained a minimum of tier 1 and tier 2 capital at 10%. You as an auditor are required to comment whether the company has followed the prudential norm with respect to the capital requirement. So the minimum capital has been mentioned maintained at the tier 1, tier 2 capital at 10%. Now you need to prescribe, or you need to tell me what was the requirement and whether that has been met or not. Simple. What is the requirement over here and what they are required to do? Come on, guys. Pretty easy. That's simple, that we have already discussed. Correct, Shishti. Your answer was correct. Manini, then what is the required percentage over here if you say no? If yes, then like if that is there, then fine. But if no, then which is the required percentage you're talking about? Correct, Sandhya? Okay, let me show you. So this is the capital requirement which is there in the regulation itself. These are the regulations I'm talking about. Okay, these are the regulations. Over here it is said that every applicable NBFC. Okay. Sorry. So these are this one, my master directions, non-banking company. Just give me a minute. Non-banking financial company, systematically important non-deposit taking company and deposit taking company, master directions. Okay. So this is a systematically important non-deposit taking. Now I'll come to that particular point. Capital requirement. Okay. Under capital requirement, it is there that every applicable NBFC shall maintain a capital ratio consisting of Tier 1, Tier 2 capital, which shall not be less than 15% of its aggregate risk. Tier 1, Tier 2 should be 15%. Okay. However, at any point in time, Tier 1 capital in respect of applicable NBFC shall not be less than 10%. And for NBFC primarily engage in lending against gold jewelry, okay, that is 50% of loan comprises of that type of financial asset, shall maintain a Tier 1 minimum capital of 12%. Now tell me, pretty simple. Now it's also pretty simple. So pretty simple, 12%. If your answer is 12%, then it is wrong. Reason because it says that the Tier 1 capital, minimum of Tier 1 capital. In our question, it was Tier 1 and Tier 2 together at 10%. So the regulation said that your Tier 1 plus Tier 2 should be 15%. Now, then there is a bifurcation for Tier 1. Sorry, apologies. Okay. Then there is a bifurcation for the Tier 1. The bifurcation for the Tier 1 is that if gold for gold companies, gold NBFCs, Tier 1 should be 12%. For other NBFCs, it should be 10%. But this 15% criteria is required to be matched. So most of you will report 12%, but that is for only Tier 1. I need to have a Tier 1 at 12%, Tier 1, Tier 2 minimum at 15%. Clear? So Tier 1, Tier 2, not less than 15%. But if it is engaged in the gold jewelry, my Tier 1 will be 12%. Clear? Any doubt? So it's not 12, it's 15. So in our case, the Tier 1, Tier 2 was 10%. That is incorrect. We need to have it 15%. Clear? Any doubt till now? Any doubt, guys? So there is one question: what is the repercussion when we if the NOF goes below 2 CR? Okay. First of all, if the net own funds goes below 2 CR, okay, then in that case, auditor is required to report as on 31st March. Number two, the company will get a time, the NBFC will get a time to revise or to achieve the previous level of NOF. But if they fail to do so, okay, then RBI can cancel their license, certificate of registration. RBI can cancel their certificate of registration, and accordingly they need to stop all their business activities with respect to the NBFC. So that can be the repercussions when falls below the your prescribed limit. Okay. Now another question is, what is tier 1, tier 2 that we are discussing over here? What is this tier 1, tier 2? So there is a definition given for the tier 1 and tier 2 capital. I'll just show you quickly. Okay. So to understand tier 1 and tier 2, you need to understand first thing, what is the own funds, what are the net own funds, and what is the tier 1, tier 2. So own funds means that your paid up capital, equity, preference, whatever it is, okay, free reserves, balance in share premium, capital reserve, okay, surplus arising out of sale proceeds of asset, but excluding reserves created by revaluation of asset, and then reduced by accumulated loss balance or book value intangibles, deferred revenue expenditures. So we need to remove these items and we need to add up the above items, then we'll get a own funds. Okay. So own funds, that is share capital, reserves, okay, all the reserves, capital reserve, share premium reserve, everything. But this is we will be adding, but what we have to reduce is losses, intangible, and deferred revenue expenditure. Also in reserves, there is a excluding revaluation reserve. Okay, all reserve but not revaluation reserve. Okay, that's the net own fund. Now, other than the net own fund, there is a tier 1 capital. What is tier 1 capital is? Tier 1 capital means own funds that we discussed, these own funds. This own fund of this particular formula, I'll carry down. Okay, this own funds as reduced by investment in shares, other non-banking financial companies, and in shares, debenture, bonds, okay, with subsidiaries and companies in same group, exceeding in aggregate 10% of own funds. Okay, so whatever amount you will get over here, this will be own funds. Okay, then you need to minus investment in NBFCs and investment in subsidiaries and same group, less investment in NBFC and same group, okay, but the amount which is exceeding 10%, exceeding in aggregate 10% of own funds. So what I need to do is this amount, this particular amount, which is in, if that is in excess of 10% of own funds, That is I'm required to deduct. So first of all, I need to minus 10% of own funds from this. I'll remove less from here. So whatever net I will get, net investment, that is required to be deducted. This is required to be deducted from own funds to give you tier 1 capital. Okay. So investment in NBFC and same group in aggregate in excess of 10% of own funds. If you reduce that amount from the own funds, that will give you tier 1 capital. And tier 2 capital includes preference shares, which are compulsory convertible into equity, revaluation reserve discounted at the rate of 50%. So 50% discounting for the revaluation reserve. Okay. Then general provisions, including that for standard asset or loss reserve, to the extent these are not attributable to actual diminution in the value. Okay. And to the extent 1/4% of the risk weighted assets, hybrid capital instruments, subordinate debts, perpetual debt. So if you include all these things, okay, then it will make the tier 2 capital. So that is the tier 1, tier 2 capital and net own funds definition. Own funds definition. Clear? Any doubt? Okay. If no further doubts, then let's take a 10-minute break. After the break, we'll gather back. I'll discuss one of the important amendment which is there, and we'll see some questions on that. Okay, great. Let's take a quick 10-minute break. Hello everyone, welcome back. Okay, so now one of the important provision that I'm going to discuss, okay, and that has been changed and has been adopted by various NBFCs. So it was mandatory to adopt. Okay, I'll show you what are these requirements, and these are known as scale-based requirements. Okay, and scale-based requirements are defined in such a way that, as name suggests, scale-based. So based on the scale of an NBFC, these requirements were, were created and were made. Okay, so I will discuss some important part of the scale-based requirement, that how the scale is defined, how the, on the basis of scale, the NBFCs are defined, and how further on, the requirement of the scale-based NBFCs. Okay. Okay. So for scale-based NBFCs, okay, the thing is that this particular the scale that I'm talking about is divided into 4 categories. Okay. One is your base layer NBFCs. That is base layer NBFCs. Okay. Second is your middle layer NBFCs. Third is your upper layer NBFCs. And fourth is your top layer NBFCs. Okay. On the basis of scale, the NBFCs are divided in 4 categories. That is middle layer, base layer, middle layer, upper layer, and top layer. Okay. Now, when I talk about base layer, it is also known as NBFC, BL, middle layer known as NBFC, ML, upper layer is known as NBFC, UL, and top layer is known as NBFC, TL. Okay, so these are the terminologies which are used. Till now, I know you have seen a lot of terminologies with respect to the NBFCs. And the purpose of these particular, terminologies like TL, UL, ML, BL was to remove the confusion of the previous terminologies. I'll tell you how. Okay. Before that, I want to show you on the financial statement level, okay, that how this adoption is done. I'll show you one of the scenario in the financial statement that was recently, issued. So okay. So I'll just show you an extract from a particular financial statement, which, ratios, and on the basis of which they have done this particular, what do you say? Okay. This is one of the extract from the financial statement. This is not part of the, financial statement, but the annual report. Okay. Over there, during the recent period, RBI issued following important circulars, which they have complied. One is the scale-based regulations. Okay. This is the revised framework, which was issued on 22nd October 2021, which is applicable from October 2022, subject to some clarification in AVL. And they have, like, what they are saying is this particular company is confident to adopt this particular regulations. Okay. Then on the basis of this regulation, what happens is each and every NBFC has to divide or has to, classify himself, or in the category of base layer, middle layer, upper layer, or top layer. Now there are guidelines and the definitions given. That is what is base layer, what is middle layer. So based on the guidelines, any non-deposit taking, again, so it goes to the non-deposit taking NBFC below the asset size of 1,000 crores. Non-deposit taking below the asset size of 1,000 crores, or NBFC is undertaking following activities like peer-to-peer lending, account aggregator, non-operative finance holding companies, NBFCs not availing public funds, not having any customer interface. These NBFCs will be classified as the NBFC base layer. Remember in my last lecture, I talked about the type of NBFCs, and one of such type was NBFC non-operative finance holding company. Or I told you there are multiple types. So what they have done is they have combined some of the types. Let's say one, non-deposit taking, it may be systematically important, not systematically important. They have taken peer-to-peer, they have taken aggregate, they have taken NOFHC, they have taken other NBFCs not availing public funds, and combined all together and made one, that is NBFC base layer. Okay, that is NBFC base layer. Okay, then middle layer is consists of NBFC deposit taking, all deposit taking. If it is a deposit taking, by default, it will go to the middle layer, irrespective of the size, asset size. Then non-deposit taking NBFCs with asset size of 1,000 crore or more. Okay, or standalone primary dealers, then infrastructure debt funds, then core investment companies, housing finance companies, infrastructure finance companies. All these will form part of my middle layer. Non-deposit accepting, less than 1,000 CR, base layer, more than 1 CR, upper middle layer. Deposit accepting, middle layer. And all these things, debt in fund, CIC, housing finance, infrastructure finance, all middle layer. Now comes to the upper layer. Very important. Upper layer NBFCs are specifically identified by RBI. Okay, by Reserve Bank, based on scoring methodology. There is a separate methodology on basis of which they identify upper layer NBFCs. They can say that the top 10 eligible NBFCs in terms of their asset side shall always reside in the upper layer. So the top NBFCs or top 10, or some NBFCs which are specifically what you can say informed by NBFC will become the upper layer. Now the top layer will remain empty, ideally will remain empty. This layer can get populated if Reserve Bank is of opinion that there is a substantial increase of potential systematic risk from any specific NBFC in upper layer. Then such NBFC will be moved to the top layer from upper layer. Okay, so usually the NBFCs will be like the base layer, the majority. Some then will fall in the middle layer. The top NBFCs on the market, top 10, top 15 will go on the top layer, or upper layer. And from the upper layer, if there is any NBFC where there is a high risk, potential systematic risk, or because of any such reason, then the RBI thinks no, this NBFC requires more stringent regulations, more monitoring, more reporting, it will pick up that NBFC from the upper layer and put it into the top layer. Clear? Clear what you mean? These all 4 categories: base, middle, upper, and top. So now going forward, NBFCs shall be divided in the basis of size, activity, and perceived riskiness. And on the basis of that, their going forwardly, their regulations will change. So regulations for middle layer will be different, for the top layer will be different. Till now, what was the scenario is, there was a lot of bifurcation on type of NBFC with respect to, let's say, deposit accepting, non-deposit accepting, then what do you say, different type, like what do you say, infrastructure finance company, CICs, all those, different classifications were there. And there were different regulations, as I said in the start of my lecture also, but going forward, that will be done away with the start of this particular concept that has been introduced recently. Okay. Most of application for this particular, scale-based regulations or requirements will be seen from next year. In the next year financial statements, you will be seeing, this being applied, because this is applicable from October. So either in the, quarterly results for the listed one, or in the financial year, next financial year's annual result, you will be seeing application of this. Now, so there are some clarifications also given, okay, which says that NBFC P2P, AA, NOFOH, or NBFC without public funds will remain in base layer. NBFC deposit accepting, CIC, IFC, HFC will be included in the middle layer. Okay. And SPD and IDFC NBCs will always remain in middle layer. Investment credit companies, microfinance institutions, NBFC factors, mortgage guarantee companies could lie any of the layer based on their type of the activity. Okay. Government-owned MDSCs shall be placed in the base layer or the middle layer based on the case-to-case basis, but they will not be placed in the upper layer. So that is some of the clarification they are given, that where which MDSC will fall. Okay. Now the references, how the reference will change going forward. So the reference, that is NBFC ND, non-deposit accepting, shall mean NBFC BL, base layer. NBFC deposit accepting, non-deposit accepting, systematic important, ML shall mean ML or UL, as the case may be. Okay. So if the NBFC is deposit, non-deposit accepting and systematically important, that will classify into ML. And NBFC, deposit accepting will be classified into NBFC ML. So going forward, gradually, the terminology that ND, SIND, or whatever we were using now will be shifted to the ML and UL. Okay. Then, so there are certain, requirements which are there for the NBFC base layer, middle layer, and upper layer that I will be discussing now. Okay. So now the net own funds requirement. As of now, okay, NBFC P2P, AA, or NBFC with no public funds and no customer interface shall continue to be 2 CR. For them, there will be 2 CR. So there will be no change for these particular NBFCs, and also for NBFC, IFD, IFC, MGs, HFC, SFB, there is no change in the NOF as of now. But there has been change for 3 NBFCs. ICC, NBFC MFI, or NBFC factor. For them, they will increase 10 crore the net own funds criteria, and that to be achieved by March 27. So currently it is 2 CR, 5 CR for MFI, and remember I told you for the North-Eastern region it will be 2 CR. So we were discussing NBFC registration requirement, and I discussed MFI in that. MFI 5 CR. If registered in North-Eastern region, then 2 CR. I purposefully included because the same I wanted to discuss in the scale-based regulations. So in scale-based regulations, this 5 or 2 will be, by March 25th, they are to, reach to the 7 and 5. and by March 27 that is to be achieved to 10 CR. That is a gradual increase they need to do. For factors, till now it was 5, but 25 till 25 they need to achieve 7, and till 27 they need to achieve 10. But that's the future thing. But yes, they need to gradually move to that particular level of net own funds. Okay. Again, the NPA classification. Okay. Now, remember we discussed the NPA classification for NBFCs, like 180 days asset provisioning and asset provisioning. So we were discussing about in prudential norms. Okay, NPA, if it is non-deposit accepting, it will be 18 months for 12 months. 6 months overdue will become NPA, and 12 months for lease rental, and for others it is 3 months. And for substandard, like substandard asset, it will start from 18 months, but for NBFC systematically important or deposit accepting, it will be 12 months. Remember we discussed this particular scenario. Now, under the scale-based regulations, okay, the NPA classification norms change to overdue for the period of 90 days for all the categories of NBFCs. So earlier it was 6 months in case of NBFC non-deposit accepting. For rest of them, it was 3 months. Now, instead of 3 months, they have done it 90 days. Okay. And this 6 months is gradually to be brought to the 90 days. So a glide path has been provided for the base layer to adhere to the 90 days. So till 31st March 20, they need to bring it to 150. 25, they need to bring it to 120, and 26, they need to bring it to 90. It's not the thing that right now, immediately, they need to apply the 90. No, it's the glide path that has been provided where gradually they have to reduce. Okay, this will not be applicable who are already on the 90-day NPA norm. So if you are already on the 90-day NPA norm, this will not be applicable. Clear? Any doubt? Any doubt? Okay. There is another criteria that has been introduced and that will be applicable from this year itself, from October itself, that experience on the board. In the SEBI LODR, we saw, there was a requirement for the board. Remember, in SEBI LODR, we discussed that, what should be the board constitution, and let me show you. So at that time, we discussed that the board should be, considering of such people that out of them, one should be, should have the knowledge, and, they should know about the particular things. And in the same way we had for the audit committee. So in audit committee also we discussed that, the regulation says that the particular all members should be financially literate. One member should have the accounting related, management related expertise. This particular point we discussed in audit committee for SEBI LODR. In the same way, it has been now brought into the NBFC also that considering the requirement, at least one of the directors shall have the relevant experience of having worked in bank or NBFC. So in at least one of the director of the NBFC should have this particular requirement. So that is the experience of the board that they have brought in. Clear? Okay. Now, remember we discussed about the capital requirements. Now, there are some additional requirements which are only applicable to upper layer. Only applicable to upper layer, not the base layer, not the middle layer. That is, now the upper layer is required to maintain tier 1 capital, additional tier 1 capital. Okay. So in order to enhance the quality of their regulatory capital, upper layer is also required to maintain at least 9% of risk weightage asset additional tier 1 capital. Okay. So they are required to maintain 9% tier 1 capital of the risk weighted assets. Okay. This is for upper layer. Then there are other regulations which out of them, one of the very important that I will be discussing now is restrictions on loan. This is very important, and this is applicable to NBFC, okay, upper layer and the middle layer. So this is applicable to NBFC upper layer and middle layer. Restrictions on loan. So NBFC is not allowed to grant loans and advances to directors, their relatives, entities where directors or relatives have majority shareholding, granting loans and advances to senior officers of NBFCs. While apprising loan proposals involving real estate, NBFC shall ensure that the borrowers that are there have obtained prior permission from the government or local government, okay, or any other statutory authority for the project wherever required. It should not be the case that, okay, I am going for a real estate loan, but the project or the plan of the real estate project is still not approved by the municipal authority or the state or something like that. So it is said that till the time for the real estate loans, if your project is not approved, like if you are not obtained prior permission, then you should not provide any loan to that particular project. Okay. So this is the additional requirement, regulatory requirement with respect to the restrictions on loan for the middle layer and for the upper layer. Middle layer and upper layer. Clear? Any doubt? Okay. Then there are some governance guidelines. The way we saw corporate governance for these listed entities, the same way now the government guidelines are brought in for the NBFCs. Okay. So let's see what are the government governance guidelines that they have prescribed. Now, this is applicable to base layer. And when I talk about base layer, now it comes a majority chunk of the NBFCs. Okay. And if it is applicable to the base layer, by default, it will be applicable to the higher level also, because these requirements, are, if they are instituted from the root to each and every NBFC. So we'll see for the upper layer, middle layer, what are the governance guidelines. But as of now, this is for the base layer. Okay. So for the base layer, it is mandatory that NBFC shall constitute a risk management committee. A risk management committee either at the board or at the executive level. Okay. And they will be responsible for evaluating overall risk faced by the MGSE, including liquidity risk that will be reported to the board. Now, to show you an example of the risk management committee that they are talking about here, the already listed NBFCs has, because through the SEBI LODR regulations, the listed NBFCs already are complying with this particular requirement, but still to show you. Just give me a minute. Let me show you. Okay, here it is. So as of now, the risk management committee is formed under the SEBI LODR regulations in this MBSE, but now this will, be also under the RBI regulations also. So as of now the risk management committee is there pursuant to the NBFC regulations and SEBI listing regulations. Okay. So what is the role of risk management committee is provided over here to and the committee references, everything, is there on the website. When the who are the part of the committee, everything is being given on the website and in the audit report. But just to show you that yes, the risk management committee is being formed by the NBFCs, and now it will be applicable from the base layer itself. Okay. So remember when I was showing about the financial statement, there were additional disclosure requirements with respect to the exposure, related party, loan to directors. Now all those disclosures, like disclosure requirements, related party transactions, loan to directors, senior officers, customer complaints, these disclosures now will become applicable to the base layer also. Then very important amendment that has been brought for the NBFC middle layer and upper layer, that is key managerial personals. So except for the directorship that the key managerial personnel is holding in their subsidiary, okay, except for the directorship and subsidiary, key managerial personnel shall not hold any office, including directorship, in any other NBFC ML or UL. So they have provided 2 years timeline with effect from 1st October 2022 to comply with these norms. Okay. So within 2 years, if they are director, if they are a part, they need to, change, and they need to, have the directorship only of subsidiary, not of any other NBFC. I'm talking about NBFC. This does not stop you from being a director in company other than the NBFC. So if you are a director in any other company, then it is fine if till the time it is not an NBFC. Okay. Then independent directors. So based on the requirements of the Companies Act, okay. But they are saying that the independent directors which are part of the board, okay, shall not be more than 3 companies. They shall not be on the board of more than 3 companies, so 3 NBFCs, which include middle layer and upper layer at the same time. So independent director can be an independent director in case of only 3 NBFCs at a time. So independent director in case of NBFC, ML and UL can be maximum 3 NBFCs. Okay. Again, for this also a 2-year timeline will be provided with effect from 1st October to comply with these norms. Okay. From next year, 31st March 2023, this is required to be disclosed from annual financial statement and with effect from 31st March 2023. Okay, these additional disclosures are required to be given. So NBFC middle layer and upper layer is required to provide in their financial statement corporate governance report containing composition and category of directors, shareholding, and non-executive directors, disclosures on modified opinion, if any, expressed by auditors, its impact on various financial items, and views of management on audit qualification, items of income and expenditure of exceptional nature, breach in the terms of covenant in respect of loan availed by the NBFC or debt security issued by the NBFC, including incidents of default, divergence in asset classification, provisioning above a certain threshold that will be decided by RBI later on. But if there is a diversion in asset classification, like as per the auditor, it should be standard as non substandard asset, but bank is or the NBFC is classifying standard asset, or let's say as auditor is saying no, this should be doubtful, but bank is going for substandard. Same way for the provisioning. If there is a difference on the classification of the asset or the provisioning above a threshold, then that will be reported. So Rakesh, so your question was that whether NBFC, ICC, MFI or factor can continue with 2 CR for the current year? Yes. Means current financial year is 22-23. Yes, but based on the glide path, they need to upgrade their net own funds. Okay, ICC, MFI and factor, they need to upgrade their net own funds to the 5-7 by 25 and by 27 10-10-10. Till the time doesn't other any requirement doesn't come up. Okay, so this is the additional disclosure requirement. For NBFC, ML and UL. And that is with effect from 31st March 2023. So whichever annual financial statement will be there for 31st March 2020, a period ending 31st March 2023, in that will be provided. Clear? Okay. Then another disclosure requirement. Okay. Other governance requirement for the NBFC is that they should delineate the role of various committees. Like they should clarify what is the role of each and every committee: audit committee, nomination remuneration committee, risk management committee, and stakeholder relationship committee, and any other committees. Okay. Then they should formulate a whistleblower mechanism for directors and employees. Okay, so they should implement this whistleblower mechanism in their corporate governance. Okay, and these are required to be looked for the subsidiaries also. So that is some of the requirement with respect to the corporate governance and disclosure. Okay. Now there are certain requirements for the upper layer, additional regulatory requirements. Okay. So in that case, first requirement is that if a NBFC UL has been identified, this is the NBFC UL, then it has to mandatory list within 3 years of identification of being UL. So if I classify UL today or 1st October 2022, within 3 years of the classification, or later on at any point in time, if it becomes classified as a UL, within 3 years, they need to get themselves as a listed. That's a one important thing that has come up, because of this, what will happen is all the top layers or upper layer NBFCs, will now become listed entities, and SEBI LODR and other regulations along with this will be applicable to them. Then another requirement is, if a NBFC is categorized as the upper layer and later on, let's say for example, that particular NBFC is not able to meet that requirements, then it shall be subject to enhanced regulatory requirement of the upper layer at least for the period of 5 years from its classification in the layer. Even if it does not meet the criteria in the subsequent years, still it will be classified as the upper layer for 5 years. Once classified as the upper, you will be there in the upper for the 5 years. Clear? Any doubt till now? Any doubt? I'll just show you some of the scoring method for NBFC upper layer, how the NBFC upper layer is decided, but I'll not go into the detail because that is something will be decided by either RBI or the appropriate notifications will come. Okay, but see how it is upper layer decided is following criteria: top 50, either it is a top 50 NBFC based on their total exposure in credit equivalent balance sheet exposure. Okay, then NBFC which was already upper layer in the last year or in the previous year, or NBFCs which are added to the upper layer by the supervisory judgment by the Reserve Bank. If that is the case, then they will fall under the case of upper layer. Okay, now there is a parameters given: total exposure, interconnected financial system, a lot of things are given. I'll not go into this much detail of these particular things, this calculation, but on the basis of this, the score is decided. Let's say for example 100-point score is there. Okay, and this score is decided. Okay, once this score is decided, on the basis of that they decide which are the top 50 NBFCs which are having higher scores, and accordingly those top 50s will be picked up for the for the upper layer. So here when I say top 50, that doesn't mean based on the market capitalization, it means based on the scoring method. Remember that. So there's a scoring method for that. Clear? Any doubt? This was scale-based regulations that has been introduced. And for a fact, I can tell you, going forward, NBFC regulations are going to be, drastically changed based on this framework which has been laid down. So going forward, you will be seeing, all the NBFCs being classified into these layers. Additional disclosure requirement for the upper layer and the middle layers. Base layer compliance requirements will be there, and accordingly, each layer, will be having their own requirements. Instead of type of NBFCs right now, it will be layer of NBFCs then. So a good change I can say for the NBFCs reporting and disclosure. Okay, now in this particular requirement, okay, I'll take up some of the questions. Okay, I'll discuss some areas over here with respect to the questions, and then we'll see how much clarity or we need further for these regulations. Okay, ABC Limited, NBFC registered with RBI, okay, had the following net own funds, or not the following, registered with RBI, was involved in lending and financing activities the NBFC or ABC Limited, basically the NBFC, was not involved in accepting public deposit, okay, as at 31st March 2022, the net owned funds of ABC Limited were rupees 650 crores, okay, was rupees 650 crores. Now, based on the scale-based regulations, kindly classify the NBFC into appropriate category. Okay, so you need to classify the NBFC based on base regulations. Which category the NBFC will fall? Pretty simple. Trust me. Come on, guys. Pretty simple. Sorry. Yeah. Come on, guys. Pretty simple. Correct, Manini. Absolutely correct. Come on, guys. Correct, Rakesh. Correct, Shishti. Come on, I'm expecting more answers over here. There is nothing difficult. We just discussed this particular regulations. Pretty simple. There is nothing much. Correct, Rakesh. So simple. I'll go and explain. We need to focus on few things to decide whether it's an NBFC, base layer or middle layer or upper layer. Okay. So first of all, whether deposit accepting or not accepting. If that is not accepting, not involved in accepting public deposit, means as of now, it can be anywhere, middle layer or upper layer. Always go for the deposit accepting first, because if it is deposit accepting, irrespective of asset size, it will go into middle layer. So as of now, it can fall in any year. Second, asset size, 650 crores. Now, if this is less than 1000 crores, then this will be into the base layer. Greater than 1000 crores, it will be into my up middle layer. So here, this is less than 1000 CR. So this will fall into NBFC base layer. So the answer is NBFC base layer. Pretty much good. Okay. Correct, Shailendra. Now, to have, further on this, the same, we'll continue on the building same scenario. During the year, the company granted loan. The company means this one, ABC Limited, granted loan to to one of its director, okay, for 3 years at the rate of interest prevailing in the market. Okay, prevailing in the market. Now, you need to report based on above information. Kindly guide whether ABC Limited is complied with scale-based regulations. So, whether ABC Limited has complied these scale-based regulations. So, they have provided or granted a loan to one of the directors for 3 years at the rate of interest prevailing in the market. So, at market rate, they have given loan to director for 3 years. You tell me whether they are complied with the SBR or not. Whether they are complied with the SBR or not. Correct, Manini? Correct, Shrishti? Good. Correct. So let's assume they have the policy. So policy is there. Board approved policy for the lending to directors is there. They have a board approved policy. I'll insert here. This lending was on the basis of board approved policy. Sorry, not question mark. Yeah. This lending was done on the basis of board approved policy. It's there. So good, Shailendra. Okay. Now I'll discuss something. Just a minute. Yeah. Restrictions on loan. Now there is another requirement of the restrictions on loan, which says that granting loans, advance to directors. Okay, there should be regulatory restriction on this in respect of following. So as of now, granting loans and advance to director, there should be restriction. There should be restriction on granting loans to senior officer of NBFCs. Okay, and while appraising the real loan on the real estate, prior permission should be there. So there is a restriction as of now for this particular loans. Okay, but in the current case, these restrictions will not be applicable because these restrictions are for middle layer and upper layer, not for the base layer. For the base layer, if you go and if you see, over here, regulatory changes under SB are applicable to base layer. So for base layer, what they are required to have is NBFC base layer shall have a board approved policy on granting loans to directors, senior officers, and relative of directors, where directors or relatives have major shareholding. So as of now, they need to have a board approved policy, and the loan should be as per the board approved policy. There is no restriction to the base layer. The restriction is only applicable to the upper layer and the middle layer. Okay. In the current case, or in our current example, this is the base layer we already established. So it is based on the board approved policy. No restriction, perfectly fine. We can go ahead. If this would have been upper layer or the middle layer, then there would be some restrictions that they would have need to comply with it. But as of now, there are no restrictions. Clear? Any doubt? Okay. Now, the point is, what about the prudential norms, asset provisioning, or whatever we have discussed till now? What happens to all those things, in front of SBR? So, understand one thing. SBR is not overriding any of the existing provisions to the extent that we have not discussed. So if we have discussed for the net own funds, to the extent I provided you, okay, for these three entities, it will be a glide path. For other, all the provisions that we have discussed will remain same. Okay. Classification, base layer, upper layer, middle layer, it will be there. On the basis of classification, the additional requirement that we discussed will be there. But that doesn't mean the provisions or the regulations or directions we discussed earlier are no longer applicable. That is not the case. They will be still applicable. To the extent they are not merged with the scale-based regulations, they still will be applicable. And going forward, that will be there, but as of now they are still applicable. So a mix of both will be applicable, scale-based plus other provisions or directions that we discussed till now. Any doubt? Any doubt? So in this question, I told you that we are continuing the above one, that's a ABC Limited, NBFC registered with RBI, not involved in accepting public deposit, were having net worth of 650 crores. So from there we decided it's a base layer, and we continued during the year. The same company gave the loan to the one of the directors. I hope, Shailendra, your doubt is clear. Okay, let's take one more question. It's on the same line that we earlier discussed. Okay, but I just want to discuss something else also over here. Same line. What we discussed earlier, on the same line. We saw this type of question earlier also. It's on the same line. There is no difference. Okay. So paid up share capital 40.53, non-current asset 55, current asset 344.47. Okay. Then total asset of the company 530, intangibles 3 CR, profit for the year 7.25, income from interest and dividend 52, gross income 102.57, unique device for the registration under 45 IG. Same what we did earlier, same line, but there is one point I purposefully left in the earlier question, and I'll discuss it here that particular one. Come on, pretty simple. Come on, guys, pretty simple. We already did this some time ago only. It's on the same line. Okay. Good, Shrishti. Come on, guys. See, okay. I'll tell you one thing. Okay. It's on the same line that we discussed earlier. Let's do it together. So, to check whether it is meeting the registration requirements, I need to check two things: principal business and net owned funds. Again, I don't have that much sufficient detail over here to calculate the net owned funds, because remember, I showed you the what do you say, basically the formula for the net owned funds: equity plus reserves plus everything, we saw there was a requirement for the net owned funds. So I do have a paid up share capital, but I don't have the reserves as of now. So considering that, I won't be able to calculate the net owned funds, but assuming the total assets, I'll assume that net owned funds requirement is achieved of 2 CR, because capital itself is 40 CR. So any which ways, it is going to achieve the net owned funds because we have a profit, there is no loss. Okay, so I can say that okay, net owned funds are getting achieved. If I show you in my requirement, so net owned fund, what's share capital, reserves excluding revaluation, minus loss, minus intangible, and deferred revenue expenditure. Okay. Now, sorry, here. So I'll say net owned funds 2 CR is achieving because my paid up share capital is more enough than the net owned funds. Principal business. To decide the principal business, I need to have a 50-50 test. 50%, more than 50% my total asset from such business, and more than 50% of my total revenue, more than 50% of total revenue from such business. Okay, so my such business, principal business, should be of NBFC. Okay, now my total asset is 530. My total asset is 530 CR. Correct? But what I will do is a thing which I did not do earlier purposefully, just because I wanted to show you from where it is coming. I'll reduce less intangibles. I'll reduce the intangibles. And this is for the purpose, like reducing the intangible here is for a purpose, reason because remember we discussed about this particular thing, the own funds calculation. In that own funds calculation, we discussed, okay, we deduct the particular, requirement, what do you say, intangibles. Okay, so over on the same line, we are required to reduce the intangibles over here also. So this intangible, why it is deducted, it is coming from here. If you see, we are removing intangibles and deferred revenue expenditure from own funds. On the same line, we need to remove the intangibles and deferred revenue expenditure sort of things from our, what you say, total asset also. Reason because if you want to compare something with something, they should be on the equal line. On the same line, we are required to remove the intangibles from total asset, and then we will get total assets netted of intangibles 527 for the comparison. Now I need to compare this netted off portion, of 527 to my current and non-current total. This current and non-current total will be 400.37 CR. 400.37 CR from finance or financing, what you say, loans and advances, NBFC business. If I divide by 527, it is way more than 50%. I know that. Same way it will go for the revenue. I need to take 52 CR, and in front of that I need to compare with the gross income. Okay, I need to take 52 CR and I need to compare with the gross income, that is again it comes to this come to more than 50%, and 50-50 test has been achieved. Clear? So in the above question also, I did not reduce this particular intangible from here. The intangible was 6.35. So the comparison I need to do is with 3 points after netting of the intangible. This comparison here should be after netting. Sorry. And why this is netted off? Reason because when you calculate own funds, okay, on the same line over there also we reduce the intangibles because that is something we never count as an asset. For an NBFC, intangible is not an asset. That's then amount that has been gone. That's why from everywhere it is being reduced. So for NBFCs, the assets are which at a later point in time you can derive any economic benefit. So as of now, considering that it is not considered intangible, intangible is not considered in that particular category, and hence the same has been netted off. So other intangibles are removed from everywhere, even from the calculation of total asset to calculate the test of 50-50. Clear? So this is how I need to calculate this particular quotient. Remember, intangibles are to be netted off. Any doubt? Okay, see, there are a lot of regulations in NBFC. NBFC is not a what you can say, like simple plain vanilla entity. NBFC covers with a lot of regulation because it's the type of the nature of the the business they carry on. They are not banks, so they are not regulated that much. But on the same side, they are of such nature that they public can be substantially interested in them through way of public deposits, or they are dealing in money. So on the same time, it is required that they should be there should be some provisions or some restrictions, regulations, compliance on these entities to make them par with the banking, or at least near to them, banking, to make them near to the banks. That's why these so many regulations you are saying that on the public deposit, on prudential norms, asset provisioning norms, now scale based returns, audit one, everything is interconnected. Okay, so I'll suggest start with the audit requirements, and as we proceeded over here. Okay, these are the audit requirements. One by one, understand what is the audit requirement, which is there as per the master direction, what we are required to audit, and on the basis of that, you go and study that particular provision. Okay, it will help you to understand clearly, okay, what we are studying and why we are studying. Why we are doing all these regulations and everything. Reason because in NBFC audit report, we are required to submit a statement wherein we are supposed to, as an auditor, are supposed to specify. I'll show you one more area in that, which we have already discussed, just to show you. So, like over here, NBFC is all in case of non-banking. Yeah. In case, let's say, for example, if it's not accepting public deposit, whether we have been, whether we are complying with this particular norms, that is non-systematic important deposit, non-deposit taking norms. So of norms of income acquisition, accounting standard, asset classification, provisioning, bad and doubtful debts, okay, prudential norms. So whether we are complied with the prudential norms or not. So everywhere we are required to provide that thing, whether we are complied with the norms or not. If we are complied with the norms, then we should to report that, okay, that whether we are complied with or not, we need to understand what are the norms, applicable to them. To report, okay, they have complied, you need to understand what are the norms. And here we discussed that particular thing. As I said in the start also, we are discussing for this purpose because we have to report, being the auditor of the NBFC. Shrishti, at your question with respect to the DIC, GC, and minimum exposure to the priority sector, sensitive sectors, there's a lot of different what do you say, different level of discussion. But as of now, that is not covered over here. So that's why it in our discussion, because that's not part of the thing that we need to report to. So that's another discussion. I don't think so it will be relevant for the current session. Any doubts? Okay, let me check Bodhi on that. Any doubt, guys? Okay. If no doubts, then just one important thing I just want to update you with respect to the next lecture. So we are planning to reschedule the next lecture of the Friday, either on Saturday or Sunday. Okay, but you will get soon updated on the website, or you will get the soon updated announcement on the YouTube also, or on the portal also. Okay, so once he'll update that, so we'll keep you posted on through the portal or through the website, that when the next lecture on the insurance is going to happen. But that is as of now, we will be postponing from Friday either to Saturday or Sunday. That I will update you. Okay, so whenever it will happen, please be prepared with the insurance, audit of insurance, the requirements, the norms, the format of reporting, everything we will be discussing. We will be discussing the questions also. Okay, and please make sure you should have a reading before start of the lecture, so that when I discuss, so you will be able to get it, because the thing is, we will be discussing a lot of questions compared to the detailed provision and detailed applicability requirements. Okay, so guys, thank you for participating. Thank you for being here. I'll see you in the next lecture. Thank you.